Today, we will talk about understanding cryptocurrency, Bitcoin, Ethereum, and more. What is cryptocurrency? Cryptocurrency, or crypto, is a digital currency used as an alternative payment method or as an investment. Cryptocurrencies get their name from the cryptographic techniques that enable people to buy, sell, or trade them securely without the need for a central authority, such as a government or financial institutions. Cryptocurrency examples. There are thousands of cryptocurrencies. Some of the best known include Bitcoin. Founded in 2009, Bitcoin was the first cryptocurrency and is still the most commonly traded. The currency was developed by Satoshi Nakamoto, widely believed to be a pseudonym for an individual or group of people whose precise identity remains unknown. Ethereum. Developed in 2015, Ethereum is a blockchain platform with its own cryptocurrency, called ETH, or Ethereum. It is the most popular cryptocurrency after Bitcoin. Litecoin. This currency is most similar to Bitcoin, but has moved more quickly to develop new innovations, including faster payments and processes to allow more transactions. Theoretically, if businesses and consumers both found Bitcoin to be a better buying experience than using the US dollar, the consumer might convert more of their money from dollars to Bitcoin, while the business would welcome more Bitcoin payments. If this happened on a huge scale, demand for Bitcoin would go up, and in turn, its price in dollars would increase. How does cryptocurrency work? Cryptocurrencies are supported by a technology known as blockchain, which maintains a tamper-resistant record of transactions and keeps track of who owns what. The use of blockchains addressed a problem faced by previous efforts to create purely digital currencies, preventing people from making copies of their holdings and attempting to spend it twice. Individual units of cryptocurrencies can be referred to as coins or tokens, depending on how they are used. Some are intended to be units of exchange for goods and services, others are stores of value, and some can be used to participate in specific software programs, such as games and financial products. How are cryptocurrencies created? One common way cryptocurrencies are created is through a process known as mining, which is used by Bitcoin. Bitcoin mining can be an energy-intensive process in which computers solve complex puzzles in order to verify the authenticity of transactions on the network. As a reward, the owners of those computers can receive newly created cryptocurrency. Other cryptocurrencies use different methods to create and distribute tokens, and many have a significantly lighter environmental impact. Why are there so many kinds of cryptocurrency? It's important to remember that Bitcoin is different from cryptocurrency in general. While Bitcoin is the first and most valuable cryptocurrency, the market is large. More than 22,000 different cryptocurrencies are traded publicly, according to CoinMarketCap.com, a market research website. And while some cryptocurrencies have total market valuations in the hundreds of billions of dollars, others are obscure and essentially worthless. Are cryptocurrencies financial securities, like stocks? Whether or not cryptocurrency is a security is a bit of a gray area right now. To back up a little, generally a security in finance is anything that represents a value and can be traded. Stocks are securities because they represent ownership in a public company. Bonds are securities because they represent a debt owed to the bondholder. And both of these securities can be traded on public markets. Regulators are increasingly starting to signal cryptocurrencies should be regulated similarly to other securities, such as stocks and bonds. But this take is receiving pushback. Scholars, legal firms, and some of the biggest players in the crypto industry have argued against this, claiming the rules that apply to stocks and bonds, for example, don't apply as broadly to cryptocurrencies. Are NFTs cryptocurrencies? NFTs, or non-fungible tokens, are digital assets that convey ownership of what could be considered an original copy of a digital file. They share many similarities with cryptocurrencies, and they can be bought and sold in many of the same marketplaces. However, NFTs are different from cryptocurrencies due to that unwieldy word in their name, non-fungible. Cryptocurrencies are fungible, So any unit of a specific cryptocurrency is basically the same as any other. My one Bitcoin has the same value as your one Bitcoin. Pros and cons of cryptocurrency. Cryptocurrency inspires passionate opinions across the spectrum of investors. Here are a few reasons that some people believe it is a transformational technology, while others worry it's a fad. Cryptocurrency pros. Some supporters like the fact that cryptocurrency removes central banks from managing the money supply, since over time these banks tend to reduce the value of money via inflation. Cryptocurrency cons. Many cryptocurrency projects are untested, and blockchain technology, in general, has yet to gain wide adoption. If the underlying idea behind cryptocurrency does not reach its potential, long-term investors may never see the returns they hope for. Cryptocurrency legal and tax issues. There's no question that cryptocurrencies are legal in the US, though China has essentially banned their use, and ultimately whether they're legal depends on each individual country. The question of whether cryptocurrencies are legally allowed, however, is only one part of the legal question. Other things to consider include how crypto is taxed and what you can buy with cryptocurrency. Your decision. Is cryptocurrency a good investment? Cryptocurrency is a relatively risky investment, no matter which way you slice it. Generally speaking, high-risk investments should make up a small part of your overall portfolio. One common guideline is no more than 10%. You may want to look first to shore up your retirement savings, pay off debt, or invest in less volatile funds made up of stocks and bonds. There are other ways to manage risk within your crypto portfolio, such as by diversifying the range of cryptocurrencies that you buy. Crypto assets may rise and fall at different rates and over different time periods. So by investing in several different products, you can insulate yourself, to some degree, from losses in one of your holdings. Perhaps the most important thing when investing in anything is to do your homework. This is particularly important when it comes to cryptocurrencies, which are often linked to a specific technological product that is being developed or rolled out. When you buy a stock, it is linked to a company that is subject to well-defined financial reporting requirements, which can give you a sense of its prospects. Cryptocurrencies, on the other hand, are more loosely regulated in the US, so discerning which projects are viable can be even more challenging. If you have a financial advisor who is familiar with cryptocurrency, it may be worth asking for input. For beginning investors, it can also be worthwhile to examine how widely a cryptocurrency is being used. Most reputable crypto projects have publicly available metrics showing data such as how many transactions are being carried out on their platforms. If the use of cryptocurrency is growing, that may be a sign that it is establishing itself in the market. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.